in terms of reassessing our existing retirement structure, really that is direct investments within a self-managed super fund. That's how we've been operating to date. And the federal election made us all pause to consider the suitability, but really that's something we should do on an ongoing basis regardless. And these are the sorts of questions that as trustees of a self-managed super fund, you should be asking yourself. And they include, have you retained the desired level of control of your financial assets? Have you been able to achieve an adequate risk-adjusted rate of return? Have you received a tax-effective income stream? And have you been able to do so cost-effectively? Has the operating of your self-managed super fund been easy and efficient? And have you been able to take advantage of other benefits such as Centrelink? So at this point, if I have already given the green tick to all those items, and arguably I'd be slightly biased in doing so. But if one looked back on the last 10 years or even 20 years for a number of clients, I do feel that how things have gone to date have been an absolute success, and I'd be delighted if they continued in the same vein for the next 10 or 20 years. It has worked very well thus far. But that doesn't mean it will always be the case. Now, legislation is a prime example. Labor's introduction of franking credits was a prime example there. Regulation, I think, is a risk, and particularly increasing compliance burden on trustees. It just seems to be the world over that regulation is just being more and more forced upon us. And something that is certainly a function of change is age. So as I alluded to earlier, many clients have been clients for nearly approaching 2 decades. That's a very long period of time. So if someone joined as a sprightly 60-year-old, now they're hopefully an equally sprightly 80-year-old. And even if 80 is the new 70, time does march on, and it wouldn't be unreasonable to expect that one's desire or capacity may change at some point in the future. It's a possibility. So really, I think a key consideration in whether a self-managed super fund is appropriate or not in the long term is really a trustee's willingness and ability to continue to make sound decisions with respect to the appropriate management of their self-managed super fund. And really, regardless of age, all trustees should have a contingency plan that they can turn to. And a couple of points with respect to that: an absolute minimum is to have an enduring power of attorney so that someone is authorised to make decisions on your behalf if you're not able to. A sort of more involved step that opens up options down the track is to consider having a corporate trustee so that you can easily facilitate a change of decision makers in the future if that was ever required, or just have other people join the fund or people exit the fund with a minimum of fuss. Because if trustees are if the trustee is in individual names and one of those trustees, for example, someone is assisting them with an enduring power of attorney, technically that enduring power of attorney should become the trustee, and all of a sudden you have to repaper the entire self-managed super fund and the investments in it. So I feel that increasingly going forward, looking at changing people's setup to use a corporate trustee will become more and more relevant. And I think the other thing to consider is potentially alternative superannuation structures, or be prepared to wind up your self-managed super fund. I don't want to go into that in detail. Unfortunately, generally they often come with negatives and they don't necessarily address the wider issue. For example, if you said that you felt it was no longer appropriate to be a self-managed super fund trustee, you wound it up and you moved the investments into your own name, well, you still have to make the decisions about the investments in your own name. It's just in a different vehicle. So, but it still is worthwhile being aware of other options available, but strongly I think the enduring power of attorney and gradually moving to a corporate trustee will become more applicable. So a corporate trustee is literally a corporate entity, but it's a special purpose entity that is there simply to be to fulfil a trustee function. So the difference is that you don't have to lodge an ongoing annual return with respect to that company structure. It's just essentially a name. It still has a constitution and all the key parts of being a company, but it's like a dormant company from an operational sense. So you're not having to do an annual taxation return or set of accounts. If you're an individual trustee of a self-managed super fund, there must be 2 individual trustees and there's a limit of 4. Okay. Now, if it's a corporate trustee, you only need 1 director. So a corporate trustee is a logical solution. If there's only it's a 1-member self-managed super fund, then that really sort of directs you to using a corporate trustee. So it's literally a company structure, Steve.
But the director of that?
Well, the director will be the member of the fund.
Okay.
Yeah. So instead of the husband and wife being the trustees of their self-managed super fund, it will be a corporate trustee, XYZ Company Proprietary Limited, and then the husband and wife will generally will be the directors if they are a member of the self-managed super fund. But if, for example, either the husband or wife was not able to operate and enduring power of attorney, for example, was in force, well, the person that has enduring power of attorney could become the director of the company, and the member could be removed as a director because they're no longer able to fulfil their functions, but the operation of the self-managed super fund continues on.